The IRS is about to tax your Social Security lump sum payment, and unless you act before the deadline, you could end up paying far more than necessary. Thousands of retirees believe this money is completely tax-free because it's simply back pay for benefits they were already owed. Unfortunately, that's not how the IRS sees it. Millions of retired teachers, firefighters, police officers, and other public servants finally received long overdue Social Security payments after Congress changed the law. The average payment was around $6,700, and together those payments totaled nearly $17 billion. For many retirees, it felt like justice after waiting decades. But there's one problem. Under current IRS rules, that entire lump sum payment can count as income in the year you receive it, not the years it actually belongs to. That one rule alone can increase your taxable income, push more of your Social Security benefits into the taxable range, move you into a higher tax bracket, and even increase your Medicare premiums in future years. The filing deadline is approaching quickly, and the IRS isn't going to send you a letter explaining any of this. That's exactly what we're going to cover today. Before we begin, a quick reminder. This video is for educational purposes only. It is not legal, tax, or financial advice. Always consult a qualified tax professional before making decisions about your personal situation. My name is Kevin, and on this channel we break down retirement taxes, Social Security rules, Medicare, and the financial mistakes that cost retirees thousands of dollars, all explained in plain English. If that's the kind of information you're looking for, subscribe now and turn on notifications so you never miss an update. Now let's understand how this entire situation started. For more than 4 decades, millions of public employees were affected by 2 controversial Social Security rules known as the Windfall Elimination Provision, WEP, and the Government Pension Offset, GPO. These rules mainly affected teachers, firefighters, police officers, and certain federal employees who worked in jobs that didn't pay into Social Security. Even if they had spent years paying Social Security taxes through other jobs or qualified for spousal or survivor benefits, their monthly benefits were often reduced dramatically or eliminated altogether. Some retirees lost several $100s every month. Others lost their entire benefit. Many surviving spouses expected to receive Social Security after losing their husband or wife, only to discover those benefits had been reduced to zero. For years, millions of Americans fought to repeal these rules. Finally, on January 5, 2025, Congress passed the Social Security Fairness Act. The law completely eliminated both WEP and GPO and made the change retroactive to January 2024. That meant anyone affected was entitled to receive all of the benefits they should have been paid beginning in January 2024. The Social Security Administration quickly began sending those payments. Within a few months, more than 3 million retirees had received retroactive checks totaling roughly $17 billion. For many families, it was life-changing money. But that's where another problem appeared. According to current IRS rules, retroactive Social Security benefits are generally taxed in the year they're received, not the year they were originally owed. So if you received a lump sum payment during 2025, the IRS treats that entire amount as additional Social Security income for your 2025 tax return. And that single income spike can create several unexpected tax problems. Let's look at exactly how it happens. Let's look at a few real-world examples to see how one lump sum payment can completely change a retiree's tax situation. Scenario 1. Imagine a retired teacher in Ohio. She's 68 years old and receives about $22,000 a year in Social Security, along with an $18,000 state pension. Before receiving her retroactive payment, her provisional income was around $31,000. That placed her in the range where up to 50% of her Social Security benefits could be taxable. Not ideal, but still manageable. Then she received a $7,200 lump sum payment under the Social Security Fairness Act. Under IRS rules, half of that payment, $3,600, is added to her provisional income. Suddenly, her provisional income rises from $31,000 to $34,600. That small increase pushes her past the $34,000 threshold for single filers. Now, instead of having up to 50% of her Social Security taxed, Up to 85% of her benefits become taxable. The result? Her federal tax bill could increase by $2,000 to $3,000, all because of a payment Congress said she should have received in the first place. No warning, no explanation, just a larger tax bill. Scenario 2. Now consider a married couple in California. Both spouses are retired firefighters, and both were affected by the old WEP rules. Together, they receive a retroactive payment totaling $14,000. At first glance, it simply looks like extra income. But it creates another problem. That additional income pushes their modified adjusted gross income, MAGI, above one of Medicare's income limits. That matters because Medicare uses something called IRMAA, the income-related monthly adjustment amount. If your income exceeds certain thresholds, Medicare increases your Part B and Part D premiums. Here's the important part. Those premiums aren't based on your current income. They're based on the tax return from 2 years earlier. So a one-time payment received in 2025 could increase their Medicare premiums in 2027. Depending on which IRMAA tier they enter, each spouse could end up paying an extra $70 to more than $200 every month for an entire year. Their financial situation didn't really improve. Their monthly retirement income didn't permanently change by that amount. A single retroactive payment simply made one tax year look much larger than normal. Scenario 3. Now think about a 72-year-old widow. Her late husband worked for the state government. When he passed away, she applied for Social Security survivor benefits. Under the old government pension offset rules, those survivor benefits were almost completely eliminated. After the Social Security Fairness Act became law, she finally received the money she'd been denied. But because she now files as a single taxpayer, the income limits are much lower. For single filers, the first Social Security taxation threshold begins at $25,000, and the next major threshold is $34,000. Her retroactive payment pushed her above both. In one tax year, she went from having little or none of her Social Security taxed to having up to 85% of it become taxable. She's already adjusting to life after losing her spouse. Now she's also dealing with a higher tax bill created by a payment that was supposed to make her whole. Scenario 4. Finally, consider a retired police officer. He filed his tax return early using standard tax software. He saw his refund was smaller than expected, paid what he owed, and assumed everything was correct. What he didn't realize was that he had missed two valuable tax strategies that could have significantly reduced his bill. The first is called the lump sum election. The second is the new senior bonus deduction. Together, those two provisions could reduce taxes by thousands of dollars for eligible retirees. We'll cover both of them next, because they may be the most important part of this entire video. The biggest mistake retirees are making isn't receiving the lump sum payment. It's filing their tax return the normal way without realizing the tax code already provides tools that may reduce or even eliminate much of the additional tax. Many people simply accept the higher tax bill, pay it, and move on. But if you received a retroactive Social Security payment under the Fairness Act, you may have options, and using them could save you thousands of dollars. Let's start with the first strategy, because this is where many retirees can save the most money. It's called the lump sum election, and surprisingly, many people have never heard of it. When you receive a retroactive Social Security payment, the IRS doesn't force you to report it only one way. Instead, you generally have two options. The first option is the default method. You simply report the entire lump sum payment as Social Security income in the year you received it. That's exactly what happens if you file your return without making any special election. Unfortunately, that's also the option that often creates the biggest tax bill, because the entire payment lands in a single tax year. But there's another option. The IRS allows many retirees to use what's known as the lump sum election. Instead of treating the entire payment as current year income, this method lets you calculate how much of those benefits would have been taxable if they had been received in the earlier year they actually belonged to. You compare both methods and simply choose the one that results in the lower tax. The important part is this: you do not need to amend your previous year's tax return. Everything is calculated on your current return using the worksheet provided in IRS Publication 915. For retirees whose lump sum payment pushed them into a higher Social Security taxation bracket, this election can reduce their tax bill by hundreds or even thousands of dollars. If you paid tax on a Fairness Act payment, ask your tax preparer one simple question. Did you calculate the Social Security lump sum election under IRS Publication 915? If they didn't, there's a good chance you paid more tax than necessary. Now let's talk about the second opportunity. Unlike the lump sum election, this one is brand new. The One Big Beautiful Bill, signed into law during 2025, introduced a new deduction for taxpayers who are 65 or older. Eligible seniors can claim a deduction of $6,000 per person. If both spouses qualify and file jointly, that becomes $12,000. And this deduction is in addition to the existing extra standard deduction available to seniors. It wasn't available before 2025. That's why many retirees, and even some tax preparers, still don't know it exists. For taxpayers whose income falls below the phase-out limits, this deduction can significantly reduce taxable income. For someone in the 22% federal tax bracket, a $6,000 deduction could lower federal taxes by roughly $1,320. For a married couple claiming the full $12,000 deduction, the savings could exceed $2,600. Now combine those savings with the lump sum election, and some retirees could reduce their tax bill by $3,000 or even $4,000. That's real money. Money that belongs in your retirement, not sitting with the IRS. One more thing. Some people have heard about proposed legislation that would completely eliminate federal tax on these restored Social Security payments. A bill has been introduced in Congress, but as of now, it has not become law. That means you should not assume your lump sum payment will automatically become tax-free. If the law changes later, you may still have the option to amend your return. But waiting for Congress instead of filing correctly could leave you facing penalties and interest if nothing changes before the filing deadline. The safest approach is simple. File your return correctly under today's rules. If future legislation provides additional relief, you can always amend your return later. At the end of the day, the Social Security Fairness Act corrected a decades-old injustice for millions of public servants. But while Congress restored those benefits, it didn't eliminate every tax consequence that comes with receiving them. That's why understanding your options matters. A few minutes spent reviewing your return today could save you thousands of dollars tomorrow. If you or someone you know received a Social Security Fairness Act payment, don't assume your tax return is automatically correct. Review it, ask questions, and make sure every deduction and every election you're entitled to has actually been applied. Sometimes the biggest retirement tax savings don't come from earning more money. They come from knowing the rules before it's too late. If you found this helpful, subscribe for more straightforward retirement tax guides. And before you go, let me know in the comments. Did you receive a Social Security Fairness Act payment? And did it change your tax bill this year? I read every comment, and many of your questions become future videos.